Banking executives found themselves in the hot seat on Capitol Hill. Meanwhile, Wall Street had a nice comeback day. In fact, the Russell 2000 was particularly impressive because it gained back all of what it lost yesterday and then some. So we're going to take a look at all that market action. We're also going to look at a trade application example from that red hot discretionary area today, looking at a retail name to see if we can maybe do a bullish play on that. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's April 10th, 2019. First of all, if you're new, welcome aboard. Remember to go to YouTube, click subscribe. While you're over there, go to our description area and sign up for our email distribution list. Not only does that give you a heads up on when we're sending out these videos, but it also gives you a heads up on what stocks in the S&P 500 are giving you overbought and oversold cluster signals. In addition to YouTube, we're heavy users of Twitter. Make sure you're following me at Brandon Van Zee. And anytime you guys see these videos floating around, we'd encourage you to click like and retweet if you get value out of having us come to you on a daily basis here on YouTube. In addition to that, we also have a presence on Facebook. Check out our group embedded in the web address right in front of you. All right, let's go ahead and dive into the charts. As you can see, I've got chart 4B pulled up in front of us here for our premium market scholars. Someone did make a comment here regarding how clear the picture is, and just a reminder that you guys as users of YouTube are the ones that control the clarity and the crispness of the charts themselves. We always record in HD at our highest level, so if you are seeing blurriness on your side of the equation, make sure you adjust your toggle settings within YouTube Player itself. But anyway, as you can see here, we did have a bullish day across the board. The S&P 500 was up 0.35%. The Dow Jones was up 0.03%. The NASDAQ Composite was up 0.69%. And the big kahuna, at least today, was the Russell 2000 up 1.4%. As mentioned in the intro, that completely erased yesterday's above average loss. And remember, that is fairly commonplace. Remember that the Russell 2000 is kind of viewed as a little bit easier for traders to manipulate and easier for them to throw small cap stocks around. And so you oftentimes do find bigger moves both on the upside and the downside with the Russell 2000, but that is a very bullish sign to see it snap back as quickly as it did, especially considering yesterday we were awfully close to that moving average. And notice where we're at versus the 30-day moving average was much closer yesterday for Russell 2000 than any of these other charts here. So really, if we'd had a follow-through day to the downside today, we might have been looking at a situation where the Russell 2000 was trading below the moving average. So for it to snap back above again and kind of up at the upper end of its range here over the last month or so is a very promising sign right there. Now, one thing that you do want to be on the lookout for, let me right-click on this chart and go into the maximize sell area here, so that way you guys can see this all in one screen blown up here. But one thing that you do want to watch out for with the Russell 2000, because it has been our lagging index here over the recent time period, notice that our blue line, which is the near-term line here, has fallen fairly significantly. In fact, yesterday it was below 50. It did pop back up above 50 today, so that's a good sign. But what I'm going to be looking out for here in coming days is where will this blue line top out? The fear at this point would be that maybe it rises a little bit, does not get up into the upper reversal zone above 80, and then forms a lower high and starts reversing course lower. Now, if that were to occur, then that sets up that possibility of a bearish near-term divergence, because as you can see, the trade itself, or the security in this particular situation, the Russell 2000, has been trending higher. So, you know, if you have price saying one thing, yet a technical indicator saying another thing, sometimes that can be a little bit of a advanced warning sign of sorts. So let's keep our eye on that, and I'm sure David will point that out if it does occur over the next couple of days. By the way, David, unfortunately, is sick today, so that's why I'm doing the video for him tonight here on a Wednesday, when typically I would be doing it on Thursday. So we're just switching this week, so he'll be with you tomorrow, assuming he's in a little bit better shape than he has seemed to be this morning. So anyway, that's what we'll be looking for there on the Russell 2000. The other charts look pretty decent. In fact, we were talking about the relative strength in last night's video regarding the NASDAQ composite, and today proved that case in point, because today we saw the NASDAQ go up 0.69%. Unlike the Russell 2000, which still has a little bit of work to do to get back to its multi-month highs, the NASDAQ actually hit a new multi-month intraday high and a new multi-month closing high. So that strength within technology and more cyclical areas that oftentimes find themselves in the NASDAQ continues to carry the day here for the U.S. markets. Let's go ahead and now take a look at our next setup, which will be chart 4C. This is the 3 green arrows chart setup. Not a whole lot of change here. Remember, these are not the types of signals that will change on a day-to-day basis, so not entirely surprising to see that we maintain 3 green arrows across the board on all 4 of our charts, considering that all these markets were up today. And so not a whole lot to report. One thing that I'll reiterate that I mentioned last night as well, be aware that the Russell 2000 does have that kind of yellowish color of the moving average right there, which is basically telling us that we have kind of a deviation of sorts in mentalities. On the one hand, we have price above the moving average, but on the other hand, the moving average itself is kind of slipping a little bit lower. And so one of those two things will rectify itself. Either price will stay above the moving average and the moving average will eventually react by going higher, or price will eventually slip below that moving average and kind of confirm what the averages have been kind of trying to signal to us. And so that is the one that continues to be a little bit of a fly in the ointment. Otherwise, we do have fairly strongly trending markets right now. You look at some of these 3-month numbers and they're quite incredible. You look at the 3-month number out of the NASDAQ composite, we're up 15%. To put that into context for those of you that are somewhat newer to the markets, remember that over the long term, history has shown us that the stock market goes up about 8 to 10% on an annualized basis. Now, rarely does it fall directly between 8 and 10%, but when you average everything out over the years, that's traditionally what has been viewed as an acceptable reward for the risk that traders are taking by being in the market itself. So for us to be up 15% in just 3 months worth of time in the NASDAQ composite is quite an overachievement. Now, it's true, we did start at a very low point 3 months ago, so that needs to be taken into consideration as well. But nonetheless, this has been a furious rally off the lows, which does give us excellent trend trading types of conditions for those of you that practice your 3 green arrows methodology. Of course, that's the approach that I use in my Monday top-down trend trading class here at Market Scholars. All right, let's go ahead and take a look at our next chart setup. This time, we'll look at the 1040 crossover method. Remember yesterday, the big news story that I wanted to share with you was at that moment in time, we had the Russell 2000 giving us a bullish crossover. It's been quite some time since we've seen that. We'd have to go all the way back to the fall of last year. I mentioned yesterday that we've got to be careful getting too exuberant with that analysis, because it is possible that the Russell 2000 could fall for the rest of the week. And if that were to occur, it is possible that the bullish condition would not be confirmed. Remember, since we're using weekly candles here, we do need to wait until Friday to officially report whether we have a bullish or bearish crossover. But at this particular moment in time, things are looking even brighter today than they were yesterday. Remember, yesterday we were looking at the Russell being down 1.2%. Today we snapped back 1.4% to the upside. And so if we can get a couple more bullish days under the belt here to end the week, we will pretty much be assured to have a bullish 1040 weekly crossover here for the first time in many, many months. So another sign of bullishness, as if we didn't have enough of them out there already, right? Most of the signs point to higher markets. And while people like to fight that, saying that stocks are too expensive and they don't like the politics of our country and this, that, and the other thing. I mean, the truth is the charts are pointing higher. It can be as simple as that on occasion. And so will that happen forever and occur, infinitely? Of course not. We're going to have stumbling blocks along the way, but we shouldn't, get ahead of ourselves by predicting that ahead of time. We should be more reactive when that does occur, because remember, stocks do tend to go up more often than they go down. So if you're sitting on the fence, it's always easier to fall on the bullish side of the camp, just given what history has suggested. All right, let's go ahead and take a look at our next chart setup now. This will be chart 4E. This is our intermarket analysis 12 grid. Quick reminder here, as we look at these 3-month charts, the background color of the charts will determine whether we have a bullish or a bearish intermediate term posture according to the market forecast indicator. So right now we've got 2 pink charts on the board, the VIX and the 10-year Treasury yield. Both of those are considered to be bearish from an intermediate perspective. The VIX is actually below the lower reversal zone now, below 20, and we have TNX that's at 36.13 and falling. And like I mentioned yesterday, in fact, that is one big change to report here day over day. A lot of times we look at these charts while I'm giving the presentation, but a lot of times there's 2 days in between when you're looking at that review. But just given the circumstances of what I mentioned before with David being out of the pocket today, we're looking at these back to back. But just because we're looking at them day after day doesn't mean there isn't any changes. In fact, that's a pretty big change that just yesterday I was telling you to be on the lookout for, which is yesterday TNX was actually bullish and TLT was bearish. Notice the colors of the charts switched here today. And that was exactly what my fear was, because as you'll recall yesterday, I was mentioning that TNX had this nice bounce higher, a reversion to the mean type of a bounce, but we did not clear that downtrending moving average. And it looked like even yesterday we were starting to roll over. And of course that did follow through here today to then convert that posture to bearish. And so until we can start establishing support above that moving average, I will be skeptical on where the U.S. Treasury yield will take us. And then, of course, that means the opposite for TLT or the U.S. government long bonds. Bonds and interest rates move inversely to one another. So what's bad for interest rates is typically good for bond prices, and that's exactly what we found here today as well. TLT did bounce 0.24% here today, and we are now back to that nice bullish posture there. And that actually looks like it's a nice higher low that's being achieved at this current time on TLT. You'll notice here some of those interest rate sensitive types of securities out there did benefit from falling interest rates today. In particular, note junk bonds are hitting new multi-month highs, up 0.36% here today. Of course, that's helped along when we have strong oil markets, which, as you can see down below here with crude oil, we were up with crude oil prices about 0.69% today, and it was yet another continuation of that bullishness that we've seen for several months at this point with crude oil. Keep in mind that the junk market in recent years has largely been littered with oil companies, right? And that junk bond market can change its features as time goes on. Back in the financial crisis, you're probably going to find a lot more banks and brokers and those types of companies in there. But, since oil prices struggled 3 or 4 years ago, a lot of those companies came to the brink of solvency, and a lot of them did have to issue high interest debt. And so when we have found that oil prices have behaved themselves recently and interest rates have been falling, then junk bonds can be a very interesting place to not only achieve a above average yield, but also get some price appreciation as well. The other ones that are hanging in there pretty nicely, preferred stocks had a bounce today. The REITs continue to impress. REITs were up almost 1% today, and foreign bonds look quite strong, just like their U.S. counterparts as well. U.S. dollar was down here today, actually kind of an ugly looking candle there as well. We were down 0.15% when it was all said and done, but where we find ourselves is basically back to yesterday's low. So we're trying to find our way with the U.S. dollar right now. Path of least resistance continues to be to the upside with that bullish posture and that upward trending moving average, but it does kind of feel like the trend has gotten a bit heavier here recently, and so perhaps this is the time where they kind of pass the baton on to the bears at some point going forward. Now, when the U.S. dollar slips, that can be a good thing for commodities, and we did see our 3 commodity charts here do nicely today. Gold was up 0.28%, ag commodities were up 0.3%, and crude oil was up, as I mentioned before, about 0.7%. So those particular charts are starting to look a little bit more bullish as the U.S. dollar has kind of cooled off a little bit. Let's go ahead and move on to our next chart setup now, and this will be chart 4F, the foreign stock markets. All right, here we only have one pink chart. It was the same one as yesterday, Australia, but I will say Australia did go up by 0.7% today if you're using EWA as your proxy. It was actually a pretty nice looking move away from that moving average. So while the posture is bearish because the intermediate term line on the market forecast is 64 and falling, I don't know if I would be also bold to take a bearish trade on Australia right here. To me, price action looks strong enough where I think it's probably more of a hands-off trade as opposed to an out-and-out bearish type of a setup right here. I am impressed by the way it's spending the vast majority of its time above that moving average here recently. So I want to kind of see if that plays itself out to the upside or whether price action eventually confirms what the market forecast is trying to tell us right now. Other charts of interest out there, I mentioned this one yesterday as well. And again, just a reminder, I know sometimes people when they say that you kind of look at the charts every single day, nothing ever changes. That's just factually incorrect. With Russia, I mentioned yesterday I was impressed with Russia's chart. And part of the reason I think that Russia has been kind of coming into its own recently has been oil price going consistently higher so far in 2019, with a lot of those publicly traded companies in Russia being kind of attached to the oil market directly. Well, notice we had a massive breakout today. Yesterday, we were sitting right up at that horizontal resistance area where it's anybody's guess of how it reacts to that. There'll be cases where it rejects it, flops back to the other side and tries to establish a new higher low or something along those lines. There'll be other times where it approaches it, it rests there for a day, and then it breaks out. Well, that's what we got today. Russia had a very strong day, up 1.12% today. So for those of you that are looking for a little bit of kind of emerging market exposure to your portfolio and you're willing to kind of take on the risks that might come from a geopolitical perspective dealing with Russian stocks, that trend is really starting to shape up there. And as long as oil prices hold up their end of the bargain, I have a feeling that those Russian stocks could very well end up seeing some progress to the upside as well. Other areas of interest, Mexico, still kind of hanging out at that area where it's been trying to break out here recently. And then one other thing I wanted to report, Israel. I saw some tweets from the president regarding Israel and their leader here today. I don't know if that played into it at all. I think they had some elections there recently. Well, Israel was up 1.59% here today if you're using EIS as your proxy. And notice that was an important amount of price appreciation because it now takes our chart to 3-month highs. We closed at the highs of the session on Israel today and, of course, cleared this prior double top that had been in place from February 25th and March 21st. So that's a promising sign there as well, perhaps a breakout to be latched onto with Israeli stocks. Let's go ahead and now take a look at our final 12 grid, which will be the U.S. sectors 12 grid. And as we can see here, utilities are the only one that have that bearish posture or that pink hue to the background of the color there. And unfortunately, they didn't do themselves any favors here today. Notice that utilities were down 0.31% today. And so we actually closed below the moving average just ever so slightly here today. But that doesn't help their cause, right? You would expect that perhaps a bounce would occur around that moving average, and it looked like it wanted to do that right here on this candle on April 5th, but it rejected it, decided it just wasn't its time, and has really spent several days largely going sideways. So right now there is not strength in utilities, but as I mentioned yesterday, that's not always the end of the world. Remember that if you want a really healthy, robust, risk-taking market, then it is okay and acceptable for utilities to kind of be left in the dust by the more cyclical areas out there. Yesterday I talked about the communications sector specifically. We talked about that Disney trade. Well, notice that communications had another brilliant day, up 0.43%, hitting yet another multi-month high there for communications. Technology, another brilliant day as well, up 0.7%. Remember, technology was the leading sector on my sector selector tool, and it is now at multi-month highs here, up basically 20% in just 3 months time right there. Discretionary also had a nice day, up 0.48%. 8% here today. And that kind of leads us into our trade application example for today as well. Now, after hours tonight, Bed Bath & Beyond did report their earnings, and while this is being recorded within the first hour of the close of the market, when I looked at it initially, it was up after reporting its earnings, and Bed Bath & Beyond has been on a pretty nice move here recently, along with a lot of other retailers. We've talked about Lululemon and PVH and a few of the others here in my presentations along the way. So I kind of wanted to stick with that theme. I'm going to come on over here to chart, let's call it 4A, just to look at a market forecast 1 grid here. And first of all, just to confirm, here is BBBY. So there's that big up move right there that we've been dealing with here recently. That does not include after hours activity, by the way, but it was already up 5% in today's session all by itself, even before they reported earnings. We also talked about Lululemon. Lululemon hanging up there close to multi-month highs. PVH hanging out up there near multi-month highs. If you look at RTH, which is an ETF that tracks retail stocks in general, notice we had a really nice day out of RTH, up 0.35%, and clearly that's an uptrending security that we're dealing with there with a bullish market forecast intermediate term posture. So with that background information handy, what I thought we would do here today is look at a stock that looks a little bit different than those types of charts, but is a competitor to many of them, and that's Abercrombie & Fitch. Now notice Abercrombie & Fitch, which is ticker symbol ANF, was up nicely today. 3% to the upside, which is part of the reason that I wanted to take a look at it here during this presentation. Some of you that have been with us for a long time might be familiar with the acronym CAHOLD. And if you haven't heard of that before, it basically just stands for close above the high of the low day. And so we've had this swing low here recently in Abercrombie that basically bottomed out yesterday, just a hair below that rising 30-day moving average. And today we had that nice snapback rally. So yesterday's candle would be considered the low. So if we want to close above the high of the low day, yesterday's the low day. What was the high yesterday? It was up here, if you see with the H colon, when I point at that, $25.10. So of course, with our closing price today at $25.50, it's clearly a close above the high of the low day. Not only that, but I think it's also impressive that this stock closed just a hair above that moving average. I know that's probably hard for some of you to see there because that moving average is currently colored yellow, but take my word for it, we did close just a skosh right above that moving average right there, so it retook that moving average. Now, in addition to that, the other reasons that I thought it would be kind of an interesting trade setup is because when they reported earnings last was March 6th. Many of you know that we're going to get into earnings season in a big way here at the end of this week with several of those banks reporting. And so over the next 3-4 weeks, we're going to have an avalanche of earnings announcements coming our way. For those of you that do not like to trade through those earnings announcements, it can make it a very difficult task to find appropriate setups. Well, Abercrombie & Fitch is kind of off cycle when it comes to their earnings reporting. And so the next time that they report will likely not be until early June. And so that sets us up for the possibility of still trading those May options contracts if we want. Notice that the stock did gap higher very nicely off of their earnings announcement last time. It continued that move higher for several days before kind of giving up the ghost and going back down here. Now notice where it eventually reversed course. Came down to this candle, the low price was $24.43, but notice that the low price of that candle, if you're using my crosshairs as your guide to the left, notice that it did not breach the low point of this candle. That's an important consideration for a lot of technicians because the thought process is if it does breach the low point of this candle, then that gap will eventually get filled. In other words, that stock might fall all the way back down here to below 22. So it is important that it held the line right here and did not go lower. Now, after that occurred, it bounced yet again. Notice what happened. It put in a higher high. So now we have a situation where we have a slightly higher low and a slightly higher high. So what I'm hoping for in this particular case is that when we did pull back yet again, notice again where we kind of bottomed out on this particular candle yesterday, which would have been the new swing low, it was slightly higher than where this candle was at its low. And so you could really say we have a higher low and another higher low right here. So the hope is that this particular security then eventually makes its way back up here closer to 28 again if it's going to follow that current pattern that it's in. Now, it's anybody's guess whether that actually occurs or not, but that's kind of what you're hoping for if you're looking to take a bullish trade on this particular security. Now, notice that the posture from an intermediate term perspective is considered bearish at this point because that green line did fall out of that upper reversal zone. So it's not a perfect trade setup. This is more of a swing trade setup where you're going to be in the trade expectedly for only a few weeks as opposed to a few months like you would typically be using the green line for there. So what I thought we would do is use a short put vertical to try to take advantage of this concept and try to make sure that our break-even price is down below the low point of this particular candle back here. Again, with the philosophy that as long as we hold the lows of that candle, technicians are going to try to push this stock higher. If it does breach, then all bets are off. And that's where we're going to need our protection of our defined risk trade of that short put vertical. So let's see what we can do with that. I'm going to come on over here to the trade tab. And I've already got the trade pulled up down below. Notice I'm using the May monthly contracts with 37 days left until expiration. Remember that means that we should not have to be trading this through their next earnings announcement. And then what I've done here, as far as the strikes I've selected, a lot of times you've probably heard David and I reference the 30 delta. We had a delta that was exactly on 30 in this particular case, and that's your 24 strike. So I loaded that up as our sold strike. Remember, we're selling a put that has a higher credit, and then we're immediately buying a put with a lower strike price that has a lower premium here. The net effect of those two things is that we create a credit. So this is a $1 wide, and those of you that have traded $1 wides before will understand that at a bare bones minimum, you should be accepting a 24-cent credit or higher if you are hoping to have a return of risk of 30% or more. Now, some of you are going to have different rules, right? Some of you are going to say, well, I need to have 40% return on risk, and some of you might say, well, I need to have 20% return on risk. So, to each their own there. We're not here to tell you what to do with your own account. We're here to provide talking points, examples, and education. But for those of you that do have kind of a minimum hurdle rate of a 30% return on risk, then receiving a 24-cent credit on a $1 wide should be able to achieve that. So if I click on confirm and send, we can kind of show you here how that would play out. Let me get my calculator, and I'm going to take the $24 of max profit. I'm going to divide it by the $76 of max loss, and you can see that will amount to a 31.5% return on risk. Now, one thing to take into consideration here, this is a smaller price stock. Some of you might be tempted to take on a whole bunch of contracts when you're doing this. Obviously, you have every right to do that if you want, but I will provide a friendly warning that, remember, a lot of brokers do charge you more when you're options trading when you have more and more contracts involved. Not everybody has that, depending upon their broker. Some people get charged a flat fee. Sometimes it's per contract. It's really unique for each individual. But I do want to point that out just in case you like the trade setup and you're thinking to yourself, yeah, I'm going to go out and do dozens upon dozens of contracts here. So with that out of the way, let's go ahead and also notate what the break-even price is on this trade, which is $23.76. I will click send, and we'll see if we can get filled on that tomorrow. But I do want to come back over here to the chart and show you where 23.76 is, and it's about right in that general vicinity that I'm pointing at the chart right there. Now notice again, if you use my crosshairs as your guide and you kind of scan to the left on that thin gray line there, that break-even point will be less than the low point on that gap-up candle over there. So as long as that is held, as long as the low point on the gap-up candle is held, we should be able to make money on this trade as long as it kind of performs as expected for the next 37 days. And of course, that is yet to be seen. Anything can and will happen along the way, but at least that is the general idea behind the trade. All right, well, thank you for joining me yet again here tonight. Again, David should be with you tomorrow, assuming he's in better shape than he is today. But it's been a pleasure to be at your service again here tonight. Remember, if you get value out of these videos, we urge you to go to Twitter, click like and retweet. We always pin these particular posts to the top of our timeline, and so it's nice and easy for you guys to participate in that if you get value. If you don't get value out of these videos, don't do anything. We'll get that message as well. So with that out of the way, remember, markets are still bullish. Path of least resistance continues to be the upside, and be on the lookout for earnings coming up later this week. With that, all the best of success with your trades and your investments. Goodbye for now.